This is a lecture from Open Tuition.
This is a brief revision lecture on transfer pricing, a topic in the Advanced Performance Management syllabus. There are two principles in transfer pricing. First of all, and really the guiding principle, is that of group profit maximization. Ultimately, this is what is important to the whole group, that it gets the biggest possible profit. Secondly, we would like, if possible, for the divisions to be autonomous. This means that the manager of a division is allowed to manage the division, and in particular is allowed to identify what volume of goods that division should be producing, and where those goods should be sold, and potentially also where raw materials should be purchased from. There's not much point in having a divisional setup where you have two managers and then head office keeps interfering with those managers. They're going to get really fed up with that. So what we want to do is to set it up so that the divisions are themselves motivated by their own performance, usually divisional profit maximization, their ability to make profit, and no interference in head office. The ability to make profit is quite nice for them. There could be a cost center, but by and large, if you can set up a division as a profit center, it's likely to be more motivating than simply being a cost center. I prefer what's called a common sense approach. When you read the notes, you will see that you can set up certain rules about what to do in certain situations. But it can be quite difficult, I think, to apply those rules to specific questions. I think it's good if one can see the common sense of what's going on, and arrive at a transfer price, which will encourage the various parties involved, to act in what I would call a common sense way. In other words, we are using the transfer price to kind of secretly manipulate, divisional managers to act in ways which they think is great for them, but almost as a byproduct, it is great for the organization as a whole, because it will also happen to maximize the group profit. So here's our first little example. This is a very kind of typical, a simple example. Division A is making components, its own cost of 50, its own marginal cost of 50. It puts a markup on of 25, and it sells this then to Division B. So this 75 here is going up like this. This is the transfer price. Division B buys in at 75, has its own marginal cost of 80. So far, its total marginal costs, own plus buy-in costs, they're all marginal. It's going to be 155. It makes a markup of 45, and this is your final product, and this is going to customers. And everyone's happy. Both divisions are making a profit. This one's making 25. This one's making 45. This can be tied into budgets for total profits and so on there. The group as a whole is making a profit. There are two ways of calculating that. You could say there's 25 in one division, 45 in another division. That's 70 group profit. Or you can say, ultimately, goods leaving the group sell for 200, and the external own costs, if you like, there's 50 in Division A, there's 80 in the other one, that's 30, so you're left with 70. And it doesn't really matter which ones we do, but we know that in this setup, there is group profit available of 70, and essentially what the transfer price is doing is simply splitting that 70 in some way between the two divisions. So if we were to increase this to 30, this would come to 80. 80 would go up here. You do 160. You would have in 40. And all we've done is essentially move off there's still 70 profit, now a 30 plus a 40. All we've done by manipulating or changing the transfer price is to shift 5 more of that profit to division A and remove 5 of it from division B. And you'll see from that simple example that the transfer price, whether it's 75 or 80, is affecting the reported performance of division A and division B, and of course could be a kind of sensitive political issue. Now division B could be complaining, you've made it too easy for division A to make good profits and too hard for me to make good profits, too hard for me to hit my target and get my bonus and so on. So when you get down to behavioural aspects, transfer pricing is very important. What are the boundaries of the transfer price that would work here? And basically, for any sort of transfer to take place at all, both divisions have to play ball. Division A has to be willing to sell, and Division B has to be willing to buy. If one decides that it's not worthwhile, then it doesn't have to play ball. It will simply not buy or not sell. So here, if we were to set the transfer price up, let's say, way up to, let us say, 130, that would give this a huge kind of margin here of 80. So transfer price is 130, 50 plus 80 markup, really good for division B in there. But see what's happening. B, it's coming in at 130, it's adding 80. It's got 210 in there as its marginal cost. It's only selling at 200, even making a loss at 10. So division B will simply not play ball. It's better for division B to do nothing than to buy in at this huge transfer price and make a negative contribution of 10 per unit. We could, of course, order division B. Head office could order division B. You will buy in at 130. But again, we get back to these behaviour aspects. How cheesed off do you think the manager of B is going to be if they are being forced to buy in at a price which forces them to make a negative contribution, which obviously makes a profit impossible. Similarly, if we set a very low transfer price, if we were to set one at 40, then of course Division A would be delighted, Division B would be delighted. 120 has been making a fantastic 80 in there, but of course Division A has got a 50 there, it's going to be a minus 10. So unless you're covering the marginal cost of A will not play ball. So basically the transfer price which will work must be somewhere in the range, and this is the only rule I'm really going to say here, must be greater than the marginal cost of A, so it must be greater than 50, otherwise A will not play ball, and it must be sufficiently low that B can still make no worse than a zero contribution. So B here, it's getting in 200, it's having to pay 80 of its own, it's got to be like spare in there of 40, this is called the net marginal revenue. The transfer price cannot be greater than what am I talking about here? It's got spare in there 120. The transfer price cannot be greater than 120. If the transfer price was greater than 120, then Division B buys in at 120, incurs 80, and is just breaking even. If it was 121 and 80, it'd be in there at 201. It would not be capable of making a profit. So the net marginal revenue is the revenue obtained from selling outside less your own costs, and the transfer price must be less than that. But rather than think too much about these rules, as I say, better to think, if I were the manager of A, what would I think of that transfer price? Would I play ball? Would I want to sell goods? Make and sell goods. If I were B, with a given transfer price, would I want to buy in goods at that price and then sell them on at the ultimate selling price at 200, which I can get from customers? Within that range, provided both parties are willing to play the game, it doesn't much matter to the head office where the transfer price is. So between 50 and 120 will work. First complication. Division A can sell the components it's making to what's called an intermediate market. So here you are the manager of A. You have got two sales outlets. You can sell at 90 to the intermediate market, or as things stand at the minute, you can sell at 75 up through B. And you just see 90 or 75. 90 or 75. I'll go for the 90. Obviously. Because you're going to be making more profits selling at 90 than you will be selling at 75. Does that matter? Well, remember we want to maximize group profit. We know that if goods go up through the group, we're making 70. Okay? Oops. We know that if goods go up through the group, we are managing to make 70. If Division A takes a decision to sell directly outside, it's making 40. Is that good or bad? Well, it's not as good as 70, but whether it's good or bad depends on the volumes of units being made and the size of the markets. So let's say that the volume that Division A could make was limited to 1,000. That's the maximum number of units that A could make, and the intermediate market could absorb 1,200. So here you are, Division A, you've got 1,000 units. You could sell all of them to the outside market, because there's 1,200 available to sell there, or there's a market of 1,200 there. You could sell them all there, making 40, or you could sell them up through the group and make only 25. Of course, you'd sell them all to the intermediate market. Good for Division A, but it means for every unit made and sold, the group is only making 40. It never gets a chance for Division B to buy in and to sell any at all. And so far as the group is concerned, this is a bad decision being made by Division A. What we must therefore do is to set a transfer price which encourages Division A not to sell outside, but to sell up to B, to give the group the opportunity of making 70 overall, which means if you have kind of two competitive markets, that A can either sell up through the group at 75 as it is, or can sell outside at 90. You have to make that 75 competitive. If this was 90, If you set the transfer price at 90, Division A would be kind of indifferent as to whether it sold it up through the group or to outside. Anything just above 90 would give the internal market the edge. So the manager of A would now decide themselves, without being told, the manager of A would decide, if this was say 91, anything just over 90, would decide and volunteer to sell up through the group, giving the group the ability to make 70. And so we have, by changing the transfer price, we have manipulated that division into doing what we want, essentially. Will it work for B? Interesting. Well, if it works for B, we have to make sure B still wants to play ball. If we were to set the transfer price at 90, this would come in at 90, this is 80, this is then 170, and we could get a 30 in there. So a transfer price, something like 100 would work. 100 would give A profit better than selling outside, and would still give B the possibility of a profit, 100 plus 80, 180, give it a 20 profit. Both parties would be making a profit, and A would be willing to volunteer to sell up through the group to B, which of course is exactly what the company wants. So that was done on simply a common sense basis. What would happen, however, if let's say the B, A, could only make 1,000. Let's say that the intermediate market was 100. And let's say the market here coming out from this is 700. So overall, we've got complete spare capacity. The group could make 1,000. It can sell 100. The intermediate market can sell the 700 desired from Division B. That's 800 sales. It has actually got spare capacity in here. And here in a way, it always doesn't matter it doesn't matter what the transfer price is, but we could keep it at 75 here. We can keep the transfer price at 75 because what you would do if you were the manager of Division A, so I make a unit, I can sell it outside at 900, this is units, I can sell 100 outside at 900, I've still got 900 left. And that 900 I can then sell up through Division B, who will only be demanding 700 anyway. So we can do everything, if you like, and that's best for the group. It's best in this situation to make sure we have enough going to furnish Division B for its 700 sales. We were making a 70 in here. And also, we have enough to sell the 100 going out to the intermediate market. We're selling at 90. We're still making 40 in that. We have enough to do everything in that situation. So provided the transfer price is at least 75, at least 50, we're going to be okay. If the transfer price was down at let's say 45, it's not going to work because it's be making 5 less. So in that situation, Division A would sell 100 units at 90, making a nice profit in here of 40, and then say, well, Division B is now demanding goods at 45, but it's costing me 50. I'm not going to furnish any goods to Division B. I'm just going to stop after selling my 100 units going outside. So a common sense situation, think if I were the manager of A, what markets am I seeing? What selling prices am I seeing? Where can I get the best profit? Because that's what you're going for. And it's up to the group to set a transfer price which manipulates that manager to make decisions which are good for the group. The final example we have is where you can buy in an intermediate product. So here we have the possibility of Division B. It can buy from Division A at 75. It can buy from Division A at 75, or it can buy in from an outside market at 60. Now, as things stand, if I were the manager of Division B, this is where the choices lie, I would buy in at 60, because that would simply bring my total costs here, 60, 80, what's happening? It'd bring me in here to 140. It's going to give me a profit in there of 60, which is better than the 45. How does that work out? Well, that's not as good for the group. Because if A is making the goods, then the true outside cost is 50. If, however, instead of buying from A, it buys intermediate product from B, the true, if you like, cost of the components to the group is 60. So we are doing bad by the group because the group is now buying components at 60 rather than making them at 50. Therefore, what we have to do is to manipulate the transfer price, change the transfer price so Division B volunteers wants to buy from Division A rather than spending outside the group to buy in the intermediate product from an outside market. So what we have to do is make the two sources of goods competitive. I can buy from 60 from outside, or I can buy from 60 or below from inside. And if we were to set this, for example, at 59, 59, say, if we set that at 59, then Division B can say I can buy at 60, I can buy at 59, I would rather buy at 59. I will never consider buying it at 60. And of course, this is great for the group, because the group is now spending 50, making the component. We're giving Division A not a nice 25 profit, we're giving A a few crumbs, giving A here $9 profit. Division B is happy, it's buying in at $1 below the 60 at 59, giving a little bit more profit within there. And the group is still going to be making the profit available of 70 per unit within that. So here, put your mind in the decision-making manager's shoes. Here the decision is being made by the manager B. Two sources of components. What would you go for? Then that division makes a certain decision. Head office says, I don't like that decision. How can I change the transfer price to make the better decision more attractive to the manager of the division?